Sunday, July 16th, 2023, Monaco 64, home of alternative economics and contrarian views. We're going to look at the dollar and commodities today. I think both asset classes are showing signs that we could be embarking actually on a huge commodity bull market, a bull market actually that started in 2020, and we've seen a consolidation since the beginning of last year. And the dollar, of course, there's many reasons why the dollar, in my opinion, will continue to weaken, not just against other fiat currencies, but against commodities and hard assets in general. So that's what we're going to do today. We're going to look at the technicals and what it's telling me, and also some of the fundamental reasons. So let's start with the technicals. And I've taken a chart of the dollar index going back to late 1999, so beginning of the century, let's say. And you can see that the dollar index topped in 2001, 2002, there's like a double top, and then it dropped all the way into March 2008. And you can see below here, though, that the CRB index during that same period made a massive move, and it topped also in March 2008. And ever since then, we've seen commodities, as per the CRB, really never reach that high that it did back in 2008. And as you can see here, from 2020 up until the beginning of last year, we saw a really good move. And I think that move is just like the first few innings of a secular bull market in commodities that we're going to see in the coming years. And what we saw since the beginning of last year is a consolidation. As you can see, there's a falling wedge, and it looks like we're breaking out of that, the CRB index. And the dollar index as well. I was surprised by the move it made last year to a high of almost 115, but I think that now we've broken back below the 2017 high, and it looks set to go lower. So that's why I think commodities usually trade inverse to the dollar, and that's why I don't see things going well for the dollar, and that's why I think we're very near the resumption of the commodities bull market. And I want to show you also the dollar index versus gold. And this is very interesting because you would have thought with what the dollar index has done since 2008, when it bottomed just above 70 and then traded all the way up to almost 115 last year, you'd think gold would be a lot lower than it was in March 2008. And I remember that that move in gold vividly, because gold went up above 1,000 for the first time ever. I think the high was about 1,030. So you'd think that with the dollar index where it is now, around 100, or even earlier or last year at 115, that gold would be way below 1,000, but it isn't. Gold, as you can see here, is knocking on the door of 2,000 again. And I think it's just a matter of time until we break that triple top. So I think things are bullish there for gold, which basically means things are bearish, not just for the dollar, but also for other fiat currencies. Now, I just wanted to show you some of the fundamental reasons why I think the dollar and other fiat currencies are going to race to the bottom, so to speak, and commodities are going to become worth more, not because they become more valuable, but just because the currencies will buy less because they're going to be more plentiful. So we have a lot of news recently, of course, about the BRICS countries, about them buying gold and going on a gold standard, or going on a commodity basket. But I think if we just focus on the US and what's going on there, that's good enough to show me that things are not great for the dollar. This was a tweet from from a couple of days ago, excuse me. It says here, in just the first 6 months of 2023, the federal deficit was nearly $1 trillion. Only 6 months, and not even during a recession. The deficit is up 607% year on year. And then we have this year, the inflationary waves of the 70s. And I think it's going to be similar in the 2020s. And then we have more on the deficit here. This is from Gold Telegraph. The Treasury Department said Thursday that the budget gap from October through June was nearly 1.4 trillion, a 170% increase from the same period a year earlier. So yeah, the debt ceiling was suspended, and now Uncle Sam is spending trillions, and this is not even in a recession. Usually deficits increase in the recession. So now I want to tell you about the sponsor of this video. It's a company involved, of course, in the hot gold space. Why hot gold space? Well, central banks are loading up on gold like there's no tomorrow. Last year, net central bank gold buying was the biggest on record. We're seeing China continue to load up on gold this year, and other countries. So this company is called Gold Mining Inc. Its ticker symbol is GLDG, and it trades on the NYSE. So what's interesting about this company? Well, I think it's undervaluation, how the market is actually undervaluing it massively. So we're going to look at the numbers here. On Friday, Gold Mining Inc. Closed at 93 cents, valuing it at $158 million. But what's interesting about Gold Mining Inc. is it's got a couple of holdings on its balance sheet. It holds 20 million shares of GROY, which is one of the fastest growing gold royalty companies. And that holding is worth $37 million. And then they also own 80% of another gold mining property or company in Alaska. And that's valued at $116 million. So if you add up those holdings, you come to almost 158 million. You come to 153 million. So basically, the market is valuing the other assets that Gold Mining Inc. has outside those two at just $5 million. So what this basically means is that the market is valuing all other assets that Gold Mining Inc. has outside GROY and USGO at only $5 million. So let's see how undervalued the other properties are. Gold Mining Inc. owns 13 other projects throughout North and South America, and they have a combined amount of 22 million ounces of gold. That gold, those 22 million ounces, is in the category of resource, which means that the gold has been found but hasn't been mined. And usually when you have those kind of gold resources, it is normally valued by the market between $30 to $40 per ounce. In other words, those 22 million ounces are normally valued at least $30, which means $660 million. And you could argue they could be valued at $880 million too. So you're basically getting those resources for $5 million. So what this means is that the market cap of Gold Mining Inc. could be at least $660 million more than it's been valued at today. And this is just under normal conditions in a gold and commodity market that have not taken off yet. The other interesting point about Gold Mining Inc., aside from the fact that there's a 400% plus potential in terms of market cap, is that the company gets a flow of income from its stake in the royalty company. The other positive aspect about Gold Money Inc. is that its CEO has the expertise and the history of advancing projects like those that Gold Money Inc. has. And right now, he's working on 3 of them. Their management team is top caliber, with their co-chairman being the ex-CEO of the world's largest gold company. But the real icing on the cake for Gold Money Inc. is that analysts agree with this undervaluation, and they have a price target of $5 for Gold Money Inc. It's currently, of course, trading at 93 cents. Yes, I think it's a great opportunity. It's a heavily undervalued company. The market doesn't see the potential for now. I've bought some of the stock, but it's up to you, of course, to decide whether you think it's an interesting company. I think you should do your due diligence, and I'm going to put some links below in the description so you can look further into the company. And again, the ticker symbol is GLDG on the NYSE. With that, I'm going to wish you all a very good rest of the weekend. Take care. Bye.